Good morning, ladies and gentlemen. Thank you very much for the kind introduction. I would like to begin by thanking the organizers for giving me the opportunity to speak to you today. I'm really grateful for Asia Business Daily as well as Stanford University for putting on this timely event. It'll be my pleasure to share with you analysis my colleagues around the world do around energy transition. Today, what I'll try to do is at the beginning remind you of the scale of the challenge that we face, the progress that we have made so far, and then I'll spend a little bit of time around the potential technology pathways for us to achieve net zero. And in the end, I will share my personal thoughts around what Korea could do. Professor Wyant already covered the scale of the challenge that we face. The slide you're looking at, this shows you annual greenhouse gas emissions since the Industrial Revolution. As you can see, in the aftermath of World War II, the growth rate accelerated, and in the mid-1990s, again, that growth rate further accelerated. Today, we're emitting an average of annually 50 gigatons of CO2. And the challenge with that, as many of you are already aware, is the accumulation of greenhouse gases in the atmosphere results in global warming. Last summer, as part of its sixth assessment, the Intergovernmental Panel on Climate Change showed conclusively that man-made activity leading to excess greenhouse gas emissions has already resulted in the global surface temperature rising by an average of almost 1.1 degrees relative to pre-industrial levels. And they looked at a lot of research that proved if we hadn't emitted those greenhouse gases, then there would have not been such a change, as you can see in the line on green on this chart. If you may remember, back in 2015, when the 21st Conference of the Parties, COP21, was taking place in Paris, countries around the world came together to sign on to the Paris Agreement, pledging to keep the global surface average temperature rise by the end of the century to well below 2 degrees. And they included that stretch goal of 1.5 degrees that we have heard a lot already about. In 2018, IPCC looked at what it would take for us to keep the global surface average temperature rise to 1.5 degrees, and they concluded that we would have to stop the growth in greenhouse gases as soon as possible and then reach net zero by mid-century. After that report came out, we started to hear from governments around the world, in particular from Europe and North America, setting net zero targets. And of course, in the fall of 2020, we had President Xi Jinping during the United Nations General Assembly announcing that China would target reaching carbon neutrality before 2060. And subsequently, Japan and Korea also announced net zero targets by 2050. When the 26th Conference of the Parties, the latest United Nations Conference on Climate Change, was set to start last November in Glasgow, already these types of long-term decarbonization targets were covering about 80% of global emissions. That's really good news. Of course, not all the targets were legislated, but still we were seeing quite good momentum. And during COP, we got a couple of new announcements, most notably India announcing a 2070 target and then Vietnam announcing net zero by 2050. Today, if you tally up all the long-term decarbonization targets that various governments have announced, 90% of emissions are covered, which is great. Some, such as Korea, have legislated these targets, which is really important. Others, such as China or India's targets, is a really government position. There's still no legislation on the book. And then, unfortunately, some notable countries, such as both the US and Russia, while they talked about targeting net zero by 2050, there's actually no official government position on these targets yet. Now, if we want to reach net zero by 2050, of course, we have to understand where the greenhouse gases are coming from. Over 70% of greenhouse gases come from combustion of fossil fuels, basically from our reliance on using fossil fuels for energy. Of course, the remainder is also important, and that's around our agricultural practices as well as land use. So we have to tackle these sources. When it comes to energy, A simple way to think about how we can tackle it is look at our final energy use, as much as possible electrify that, and rely on clean electricity sources for that final energy use. And then in areas where we cannot directly electrify it, then we can indirectly electrify them, for example, via hydrogen and hydrogen produced from clean electricity. The good news is when we look at investment in these technologies, over the last 2 decades, we have seen a significant rise in investment in energy transition technologies. Last year, we analyzed the investment flows, and we found out that there was about $755 billion invested in energy transition technologies. Among these technologies, as you can see on the chart, the yellow component, which shows renewable energy, so your solar, wind farms, that takes up the most chunk of the investment, but you can see the growth rate is slowing down. The green part, which is electrified transport, so the sales of electric vehicles and investment in charging infrastructure, that's been growing quite rapidly. Some of the other areas like clean hydrogen or carbon capture and storage, they're really difficult to see on the bar chart. So for example, hydrogen, clean hydrogen specifically, we estimate there was about $2 billion worth of investment last year. So $2 billion out of $755 billion is not much, but the good news is that the growth rate was about 30%. In the power sector, thanks to significant investments since the second half of the last decade, renewables, specifically solar, have been accounting for the largest share of additional capacity. Wind is also now number 2. You can see actually last year coal fell to pretty much the last position. So that's really good. We are seeing an accelerated shift towards the growth in capacity additions coming from renewables. And this is primarily being driven by economics. Again, Professor Wyant addressed this point as well. Over the last decade, the average price of photovoltaic modules, solar modules, dropped by 89%. For onshore wind turbines, the average cost of the turbines declined by 53%. And similarly, for lithium-ion battery packs used for electric vehicles, there was an 89% reduction. But it's not just that the technologies are getting cheaper, they're also getting better. So if you look at photovoltaic, the module efficiency has significantly grown over the last decade. For wind, the capacity factor, so the efficiency of converting from the turbine capacity to the actual electricity produced, has significantly improved. And for batteries, the energy density continues to significantly improve. So they're getting cheaper and better. The result of this is when we look at, for example, building a new power plant around the world, in most places, on a levelized cost of electricity generation basis, the cheapest source of electricity is either solar or wind. Solar on this map is in yellow and wind in blue. Of course, there are still regions, such as here in Korea, where today on an LCOE basis, a coal power plant would be cheaper. Just for clarity, what levelized cost of electricity means is that we take into account all the upfront capital expenditure associated with the power plant. We also take into account all the operational expenditures and fuel costs associated with running the power plant over its lifetime. Then we look at what would the levelized power purchase agreement be needed to ensure that the equity investor meets its equity IRR. On an LCOE basis, in many places already, solar and wind are the cheapest. In places such as Korea or Japan or Indonesia, the reason coal appears to be cheap, part of it is certainly due to natural factors. So for example, Australia is far sunnier than Korea is, or Brazil has areas that have much higher wind speeds than Korea has. But also, unfortunately, it's a reflection of market structure as well. In places such as the UK, which UK doesn't have really high wind speeds or a really sunny climate, the UK's irradiation is actually lower than Korea. The competitive nature of the market has made sure that renewables have scaled up and come down in cost. In Korea, unfortunately, this hasn't happened yet due to the existing power market structure. The good news, though, is that the technology will continue to get cheaper. Of course, you may question right now, in the short term, as we have experienced inflation, is this going to continue to hold? Certainly true that the pandemic did cause an inflation for many commodities as well as the logistics associated with supply chain. And unfortunately, Russia's invasion of Ukraine has further exacerbated these issues. So it's certainly true that the input costs for renewable electricity has risen. But for thermal power plants, those input costs has risen even more. So if you look at the price of LNG that Korea imports today, or if you look at the price of thermal coal that Korea imports today, those have risen even more. And we have to remember that a thermal power plant uses fossil fuels its entire lifetime. That input cost for a renewable power plant is just at the time of construction. Once you've constructed it, there's no fuel cost associated with it. So even though that the current inflationary pressures certainly impact and probably will result in rising equipment prices for renewables, in terms of the relative competitiveness of renewables against fossil fuels, actually the current circumstances emphasize the point that renewables are better, more sustainable, and from an energy security, better alternative to thermal power plants. That still leaves the point that, of course, the sun doesn't shine all the time and wind speeds can wildly vary. So there's a question around how can we address the intermittency of renewables. On that point, we have to remember there's two different challenges. There is the short-term intermittency challenge that we have to provide frequency regulation and firming to renewables. That's the application that typically you would use a peaking power plant. So historically, that would have been an open cycle gas turbine or a diesel generator. Thankfully, because the falling cost of lithium-ion battery packs, again, in most places, you can already deploy a 4-hour energy storage system and provide that short-term firming needs of renewables very effectively. The other challenge is around when do we need seasonal storage. So for example, in winter months, it may be days where the sunlight is a lot less, but also the wind speeds are not high. So how do we try to balance out those seasonal issues? Today, we store LNG to do those seasonal balancing. In the long term, we have a few options. We could continue using our thermal power plants and equip them with carbon capture and storage, or we could try to run our gas turbines on hydrogen. Alternatively, we could also look at increased reliance on nuclear, particularly small modular nuclear reactors. All these technologies are getting a lot of attention. All these technologies are still not at scale. But in terms of the level of activity, hydrogen-compatible turbines is the one that seems to be at least having the early lead. Particularly utilities in Europe and North America are placing a lot of orders for hydrogen-enabled turbines. Here in Asia Pacific, starting with Japan, we've also heard a lot about trying to reduce emissions from coal power plants by co-firing with ammonia, with that ammonia being produced from clean sources. This is a plan that also Korea is considering, and now Japanese and Korean companies are also signing MOUs with utilities in India and Southeast Asia. At first glance, this plan seems very elegant because that means we can continue our existing coal power plants, and the retrofit cost requirements, at least on paper, don't seem to be that significant. That's the blue part of the bar charts you see on this slide. The challenge, though, is we still would have a thermal power plant that needs ongoing fuel, and clean ammonia, even though we expect its production cost to come down, it will never come down to be competitive with what thermal coal prices are. So it becomes a very expensive option. And by the way, these charts are only for 20% on an energy basis co-firing. That means you only get a 20% emission reduction. That means that the coal power plant that's doing 20% co-firing would still be worse than a combined cycle gas turbine plant. And if we compare these economic numbers with, for example, the latest offshore tender results, offshore wind tender results in Japan, you can see that the offshore wind results were actually a lot more economic than the 20% co-firing. And that offshore wind, when it's running, it's not emitting anything. And offshore wind has the advantage that it's more or less a round-the-clock power source. So its seasonal variety, depending on location, is quite limited. That doesn't mean that we don't need hydrogen or ammonia or CCS. Certainly, there will be applications such as high temperature processes where we may need to rely on clean hydrogen or CCS. If you have a basic oxygen furnace today to process iron ore, the only way you're going to be able to actually decarbonize that process is either using carbon capture storage or replacing that process with a hydrogen direct reduction mechanism. Of course, if you want to use hydrogen, that hydrogen has to be produced cleanly. Today, 99% of our hydrogen production is from fossil fuels. You hear a lot about different colors of hydrogen. The three to really think about is one, what we use today, which is gray hydrogen. This is hydrogen produced from fossil fuels. If we apply carbon capture and storage to that process, then that would become blue hydrogen. Alternatively, we can produce hydrogen by breaking down water via electrolysis process and using clean electricity for powering that process. If you use renewable electricity, that would be called green hydrogen. If you use nuclear electricity, some people call that pink hydrogen. When we look at all the different pathways, today, of course, gray hydrogen is the cheapest. It's those gray diamonds that you see at the bottom of the chart. Blue hydrogen theoretically can be today relatively cheaper than green hydrogen, although there's very limited amount of blue hydrogen production today. For green hydrogen, the cost will depend on the renewable electricity price, as well as the capital expenditure associated with electrolyzers, and then the experience of the operators in terms of ensuring that the projects are running on full utilization. As you can see on this chart, in pretty much all geographies, gray hydrogen today is more effective, and blue hydrogen appears to be cheaper than green hydrogen. By 2030, though, in most geographies, you can see that green hydrogen becomes relatively competitive even with gray hydrogen, and everywhere you can see that the green is competitive with the blue one, including even here in South Korea. And by 2050, this further improves. The reason for this is, for green hydrogen, it's the electrolyzer capital expenditure, which is the important factor, and then the renewable electricity cost. And both of those, the equipment costs are coming down. For blue hydrogen, we have to remember that it's dependent on fossil fuel prices. For green hydrogen, we are already seeing significant amounts of order volumes for electrolyzers. So cumulatively, there's about 120 gigawatt worth of orders. This is, again, a similar scale up in demand that we saw with solar and wind and batteries over the last decade. And we are seeing significant investment in production capacity for electrolyzers. Particularly, we are starting to see the same Chinese companies who scaled up solar manufacturing and brought the prices down, getting into electrolyzer production. So companies like LONGi or Songro. By the way, what's really interesting is, so you can see on the 2021 value in terms of manufacturing capacity for electrolyzers was 6.7 gigawatt. The actual demand was significantly lower. We only tracked about 450 megawatt of shipments. That means these companies are expanding despite fairly limited demand because they expect a lot of demand in the future. But it also means that the manufacturers are in intense competition with each other, which bodes well for consumers of these technologies. Essentially, it means the technology costs will be coming down. I'm not saying that there's not interest in blue hydrogen. We do track quite a lot of projects around blue hydrogen, particularly from countries with upstream fossil fuel assets, for example, in Canada, where I'm from, as well as in Australia, in the US, and Saudi Arabia. The challenge, though, is for blue hydrogen, even if the cost of CCS technology comes down, which is a question, we still have to see that happen, the fundamental economics will depend on the price of the fossil fuel commodity. So either you're producing it from natural gas or coal, so it will be dependent on what the price of natural gas or coal is. And as we're going through the current sudden rise in fossil fuel prices as a result of Russia's war, we need to remember that fossil fuel commodities have been volatile and will always remain volatile because their geographical availability is limited. Interestingly, today, because of the sudden rise in natural gas prices, on a short-run marginal cost basis in Europe, producing green ammonia, meaning using electricity to do electrolysis to produce green hydrogen and then converting that green hydrogen via Haber-Bosch process to ammonia, that's already cheaper than the existing method of converting natural gas to ammonia. So in Europe, most of the ammonia production is reliant on natural gas, but the natural gas prices have risen so high that already we can see green ammonia being effective. Even in Asia Pacific, where a lot of countries rely on LNG imports, or in some cases they rely on converting coal to produce ammonia, we can see that the green ammonia production can be effective. This is another reminder of the risks associated with over-reliance on the blue approach. If you look at Korea's latest hydrogen roadmap, and I believe we will hear a little bit more later on today around some Korean companies' interest in hydrogen. The challenge, in my view, if I may be very blunt, is that one, on the application side, there's an overly optimistic, in a way, if I may say, around areas where hydrogen is actually not the best choice for decarbonization. So for example, for road transport, electric vehicles are a much better, more efficient vector. So the targets for fuel cell vehicles, it's overly optimistic, but it's also from a decarbonization perspective not really helpful. Similarly, in the power sector, the targets around fuel cell power generation as well as co-firing with ammonia, they're overly optimistic and unlikely to be economic. The result of this is that the demand projections that have been made for 2030 and 2050 are really high, and these demand projections overly rely on imports. And while it's true producing green hydrogen domestically in Korea is more expensive than a sunny place like Australia, you have to remember that transporting hydrogen is actually very difficult. There are different pathways for transporting hydrogen. The most economic one today appears to be converting hydrogen to ammonia. If you want to convert hydrogen to ammonia, there's a cost with that process. Once you ship it over to Korea, depending on the application, you may need to convert that ammonia back to hydrogen. If you're going to use the ammonia as is, fair enough, that might be an area where importing green ammonia from Australia might be more effective than producing it domestically. But if you want to use it as green hydrogen, actually domestic green hydrogen production is going to be more effective. Now, I may have given you an impression that green hydrogen is going to get really cheap and this is going to be great and it's going to help us a lot with decarbonization. Unfortunately, even if you get green hydrogen prices down to $2 per kilogram, which is what the current hydrogen price is, for many applications, unless we have a very high carbon price, you would still not switch over. So for example, for steel manufacturing, you would have to have at least carbon prices above $80 per ton to convince a steel plant running on basic oxygen furnace to go over and make the capital expenditures to completely change their process. Those levels of carbon prices are already happening in Europe, and that's why, for example, the first green steel production plant using hydrogen came online in Sweden last year. This is another area that means that while technology costs will come down, unless we have the right policies in place, we'll not be able to get the transition to happen. It's a similar thing with carbon capture and storage. We have to remember that CCS actually, depending on application, the technology is very different. And the carbon prices required to ensure that companies use them will also be quite different. Here in Korea, of course, it's great that we have a carbon market. The challenge with it is currently 90% of the allocations are given for free. The remainder, of course, has a price, but then the other 90%, it's zero cost. So it's effectively depressing carbon pricing. Now, I've talked about quite a bit of technologies already. And before I get into potential scenarios to get us to net zero by 2050, I want to also remind you that getting to zero by 2050 alone is not enough. Depending on how we get to zero by 2050, we will have very different temperature results, because we need to remember it's the accumulation of the emissions that will impact the temperature rise. You can see on this chart that if we slowly reduce emissions towards 2050, then we probably will experience a 2 degrees temperature rise. If you want to do 1.5 degrees, that means today we have to stop growth of emissions, which, to be frank, is probably impossible. And then we have to rapidly decline those emissions every year. For our scenarios, we tried to take sort of the middle of the road, and we modeled a carbon budget consistent with a 1.75 degrees. We looked at each sector of the energy economy and considered the technology readiness. So for example, for power and road transport, already we have the technologies and most places are economic, so we give them a fairly limited carbon budget. Whereas when it comes, for example, for steel production, we give them more time, so we give them a bigger carbon budget. We don't expect them to reduce emissions right away. And then we constructed 3 scenarios to meet these carbon budgets. The first one, the green scenario, we pushed really hard on deploying renewables, and we use that renewable electricity to produce green hydrogen. In the second scenario, we rely heavily on carbon capture and storage, which means we can continue using coal and natural gas. The oil demand will still go down because for many applications of oil, such as in road transport, CCS is irrelevant. And then finally, in the third scenario, we looked at increased usage of nuclear, and where the electricity alone is not enough, producing hydrogen from nuclear. These are extreme scenarios and globally, but they essentially create a triangle where you can think of, for each country, the optimum pathway would live somewhere within these triangles. They all include an element of energy efficiency. So for example, when you go from an internal combustion engine vehicle to an electric vehicle, the drivetrain efficiency is a little higher. In building environment, when you go from a traditional boiler to a heat pump, again, the efficiency will be a lot higher. These charts show you the primary energy supply. If you look at final energy, the results become a little bit more clear. Today, in terms of final energy, oil is the #1 source of energy we rely on, and after oil, it's electricity. If you look at in all the scenarios for net zero by 2050, electricity becomes #1. In the green and red, hydrogen becomes #2, our hydrogen direct usage. In the gray scenario, because we have CCS, for many processes, we'll be able to directly continue using fossil fuels. So for example, we can continue producing steel via using coke and coal because we can apply carbon capture and storage there. So the hydrogen component in the gray scenario, the direct hydrogen component is a lot more limited. Now the question is, well, are these scenarios really feasible to do? The very first one is around, well, how much are they going to cost? And in terms of costing these, there's a lot of uncertainty because some of these technologies are still in their infancy. We estimate the range of investment required between now and 2050 would be somewhere between $96 trillion to just over $160 trillion. There's a lot of uncertainty here, but also the scenarios point out there will be different winners and losers. So for example, in the green scenario, the green components of that pie chart, these are all associated with the hydrogen industry, so hydrogen production, storage, and transportation. In the green scenario, we'll be relying a lot more on hydrogen. In the gray scenario, you can see that there's a lot more around fossil fuels and CCS, which doesn't exist in the other pies. And in the red scenario, the blue, which is investment in power generation, is the highest component because the capital expenditure around nuclear is higher than other technologies. That means we need to find funding sources. And the good news, as Dr. In also alluded to earlier, if you look at commitments that institutional investors that have signed on to the Glasgow Financial Alliance for Net Zero have already made, they have over $130 trillion worth of assets under management. So it's not really a challenge of funding sources. It's more ensuring that investors have pathways to actually invest in this area. So there's an implementation challenge, which is really real, but it's not for the lack of money. In terms of winners and losers, we can then take these scenarios and overlay them on companies' existing revenues. So for example, if you take the listed oil and gas companies around the world, their 2020 aggregate revenue was $4 trillion. If we had just an economic transition scenario, their revenues would continue to rise. If we apply our scenarios, then you can see that even in the gray scenario, which is the best scenario for them, their revenues would have to annually $2 trillion. On a cumulative level between now and 2050, that means for oil and gas sector, we have about $50 trillion worth of revenue at risk. That doesn't mean they can't do anything. Of course, as we have seen with many European oil and gas majors, such as BP, Shell, Total, they can invest in new areas such as offshore wind and hydrogen. The other thing we need to remember is if we want to have a chance at any of these scenarios, our annual investment in energy transition would have to significantly rise. Remember at the beginning I said last year it was $755 billion. What our scenarios require is for the next 3 years, we would have to have an annual investment of over $2 trillion. That means a tripling of investment. And then for the second half of this decade, the annual investment level will have to be over $4 trillion. These are doable in terms of money available, but they require a lot of particularly policy action to ensure investors have opportunity to invest. On that note, looking at Korea, the biggest challenge, if I may be blunt, is that over the last almost 20 years, Korea has not undertaken any fundamental energy market reform. The last time around Korea had fundamental energy market reform was when President Roh was in power. When Korea Electric Power was restructured and the generation units were separated, but still kept under KEPCO, and the Korea Power Exchange was set up. The challenge is electricity is extremely important for this transition, whether we talk about nuclear or renewables. But if you have a sole vertically integrated utility, which is also, by the way, the government says you cannot raise electricity prices, essentially that company alone will not be able to fund the investment required. And unless the market is more open to investment from other players, then we will not have enough investments there. Carbon pricing is extremely important, and Korea has done really well by having an emission trading scheme, but giving the allowances for free is not effective. And the last thing around government funding, so Korea, for example, on hydrogen, as a share of public spending associated with hydrogen relative to GDP, it's actually number one. It even exceeds Germany. The problem is the investment priorities. The government finances are much better spent on R&D in areas where private sector alone cannot do. For example, for steel sector, there's a lot more funding needs, but the money is not going there. The money is going there to giving us subsidies, for example, to buy really expensive cars. That's not a really good use of funding for decarbonization. Thank you very much for your kind attention.
Thank you very much. It was indeed a thought-provoking presentation. May we take this opportunity to take questions from the floor? 질문 있으신 분께서는 역시 손 들어주시면 마이크 전달 드리겠습니다. 세 번째 줄에 계신 선생님께 마이크 전달을 부탁드리겠고요. Here is the receiver. 잠시만요. 통역 수신기 착용하신 다음에 질문 주시면 지연 없이 들으실 수 있을 것 같습니다.
Dr. Izadi, thank you so much for your thoughtful and inspirational presentation, and it's a very interesting topic. Actually, you mentioned about the revamping Korean ETS to cope with the changes, dramatic changes that we need to make until 2030. Could you tell us about your opinions about how we can revamp the Korean ETS system, including eliminating the free allowance within some years and so forth? And at the same time, could you mention about your expectation of the carbon price at the global level, and whether there will be a way to integrate and harmonize the different carbon prices across the borders? Thank you.
Thank you very much for your kind question. If I may, to be fair, already since the inception of KETS, there has been some reforms which have been really great. The challenge is the pace of the reforms are a little bit slow. So if you look at it, the reform periods are every 5 years. So for example, the current phase that we are in, which started last year, this lasts till 2025. That means the free allocations, which were reduced, but this 90% allocation, free allocation, will remain in place until 2025. I think if we want to hit, for example, Korea's NDC target for 2030, that means we should reduce the free allocations much quicker. One of the very basic points is that the government should reconsider every year reducing free allocations rather than every 5 years changing that. A second factor is around specifically the power sector. So today, when the Korea Power Exchange calculates the marginal cost of generation to set the merit order for power plants, it actually doesn't include the impact of the KETS price on the thermal generators' costs. That's excluded from KPX's costs. This is something that needs to be changed. If this is changed, then this will help, for example, benefit gas generators over coal generators, but also overall it will ensure that the power market is operating on a basis where the carbon prices are truly reflective. So this is not necessarily a problem with the KETS, it's a problem with KPX having to adopt that. And I think it's not necessarily an issue with KPX, it's more an issue with MOTI really having to make sure that KPX adopts this rule. If we do start eliminating the free allocations on an annual basis, naturally this will result in the carbon prices going higher, which in turn, if this is reflected in KPX cost calculations, then this will improve the economics of both renewables as well as gas plants. So it will naturally lead into emissions for Korea's power sectors falling at a much faster rate. The current decline rate for emissions in the power sector are too slow for Korea to meet its 2030 NDC. So this would be the primary recommendation I have. In terms of carbon pricing harmonization, luckily, and to be honest, we were all very surprised that this happened. In Glasgow, there was progress made on the Article 6 of the Paris Agreement, so the rule book for international carbon trading. That means there's now an opportunity, for example, for Korean companies to consider if the KETS price for them is too high. Let's say we do the reforms and the price goes too high. They can look at investing in offsets elsewhere and then claim offset credits at a lower price. So for sectors such as, say, steel or cement, which to be fair, if the price of carbon goes really high, for now they probably have to just find a way of either buying credits or paying for that because the technology switch may take them longer. There would be other alternatives for them to do. This, of course, then opens up a host of questions around offset qualities, which are being worked on, and I think there will be opportunities there. Maybe I'll keep my answer short right there and conclude. But my main recommendation really would be to consider reforming KETS in context of the NDC target. So we have to have a realistic view. It's the same government that's setting the same target. So either we think the NDC target is impossible, okay, then we should not set that there. Or if we say that NDC target is real, then the KETS should reflect the carbon pricing corresponding to the emission reduction required.